Don't get a loan in this market. What's up guys, it's Alex, and me and my partner Matt, we're real estate guys through and through. We own a real estate company here in Austin, Texas with over 170 entrepreneurs. In all my years of real estate, I've learned a lot. So I'm giving you videos like this one today so that you don't make the same mistakes that I did when I was first getting started. I've been able to take down hundreds of deals, and not one of them was exactly the same as another, especially when it came to the financing. In fact, I've never actually taken down a property with a traditional loan. That's right, no conventional, no FHA, no USDA, none of that. But all the ways that I've taken down a deal, I've found one that I absolutely love, especially in today's market. Getting a new loan at 8% interest rate sounds like a nightmare to me, and I know you feel the same way. So how can we get one of those 2 to 3% unicorn interest rates that we were seeing just a couple of years ago? I can tell you what, no lender or bank is going to give you one. Today I'm going to tell you how you can find one of these, and why you, the buyer and the seller, are going to love it, and how you can find the perfect deal for you. But before we go any further, if you haven't done so already, go ahead and smash that subscribe button to our YouTube channel. Alright, now let's dive in. So what's this secret financing that I'm talking about? Even though that it's probably in the title and the thumbnail, it's called subject to financing. You're going to be assuming somebody else's mortgage. Now, what is subject to? What it means is you're buying it subject to their current financing that they have in place. It's a form of seller financing, and you're going to assume the seller's existing mortgage. Why is this beneficial? Well, you're not having to get a new loan. So you're going to be saving on points that you may be paying on a loan. You're going to be saving on certain closing costs that the lender might have. You might have a higher interest rate if you were to go out and get a loan yourself. But you're saving all of that. You're going to assume an existing loan that's already in place. It may have a better mortgage payment. It may have a better interest rate. It might have much better terms, and you'd be able to go out and get on your own. So what's the process of taking down a subject to deal? Well, what you're going to do is you're going to get it under contract, and you're going to go through the process just like you normally would. Here in Texas, we use the Texas promulgated forms. So if I'm buying a single family house and I am assuming the loan that's in place with the seller, then I'm going to put it on the 1 to 4 family resale contract, and in the part where it talks about purchase price and financing, I'm going to check loan assumption addendum. I'm going to attach that addendum, and I'm going to describe the details of assuming this loan, the loan that's in place. This will go to a title company. It'll have my earnest money, option money, and escrow. It'll close all the way through title, and then at closing, I'll get the deed to the property, and the loan is going to stay in the seller's name, and I'll continue to make those mortgage payments moving forward. It's important to use a good title company and attorney that knows how to navigate these transactions and make sure everything happens seamlessly and smoothly. So as a buyer, why would this be beneficial to you? Well, let's think about it this way. Today, November 9th, 2022, interest rates actually dropped a little bit this morning. CPI information came out that inflation might be slowing. However, a couple weeks ago, interest rates were at about 8%. So if you were to go and get a loan at 8% interest rate, get it locked in for 30 years, sure, you could refinance in a few years, hopefully rates drop. But wouldn't it be great if you could go assume a loan that's 3% or less today? Well, yes, it would be. And this is how you do it, is with subject to financing. You assume a seller's current mortgage that's already in place. Maybe a few years ago, they locked in a 2.5% interest rate for 30 years. That'd be great. I don't know if we're ever going back to 2.5% interest rates. So today they're 8. If you could go back and get one at 2.5% interest, don't you think you'd do it? Well, of course you would. And this is how you can do it today when interest rates are much higher. Another benefit to buying properties via seller financing or assuming someone's mortgage in place is that you don't have to pay typical lender costs. These have already been done. The original buyer, the seller, they did it in this case. They probably paid the appraisal fee. They probably paid the origination points to get the loan. You don't have to do it. You can just straight up assume the loan. Third and last, hey, maybe you don't have the best credit. Maybe you don't have good income to support it. Maybe you can't go out and get a loan. Maybe you really love this house. You want to move your family in there, or maybe it's a great investment for a rental property, Airbnb, or whatever you want to do with it, but you just can't qualify to get the loan. Maybe you don't have enough debt to income ratio. It's not high enough. You don't make enough money. You have a bad credit score. Well, you convince a seller to seller finance you this deal and allow you to assume their mortgage, you're golden. You don't need approval from the bank. You don't have to go through all these hoops. You can just straight up assume the loan, move forward, and start making payments. So why would a seller agree to keep a loan in their name and you own the property? Well, it's a good question. It can be beneficial for the seller for a few reasons. Right now we have a property under contract. This was listed on the market, and right now it's, properties aren't moving as fast as they were 8 months ago. It is November of 2022 and properties are sitting on the market for a little bit. This seller, he needs to sell. They want to get out of this property. They want to stop paying their mortgage, and they had it listed at $398. We offered around $350, and we said we'll buy it at $350, which is about market value, give or take, if we can assume your loan. So we're going to assume their loan at the 3.25% interest rate. We're going to take over their mortgage payments, and we're going to put $0 down. What we're allowing them to do is to get out from underneath this property and out from underneath this mortgage. It's still going to be in their name, but it allows us to be able to make this a profitable deal by assuming that interest rate. There are other situations where maybe somebody is in pre-foreclosure and they need to bring their loan current. In order to bring their loan current, they have to pay all the back fees and everything else that they haven't been making to the bank. And for me to buy it, I will reinstate their loan, but I want to assume their interest rate. You also see this a lot in commercial deals where a loan is in place, there's some pre-penalties, and in order to buy the deal, you need to assume the existing loan that's in place. So how do you find these deals? Good question. The way that you find these deals is by asking for them. So like I said, that deal that we have under contract right now, it is listed on the market. And the only way that we're able to find out that they would consider allowing us to do seller financing and assume their mortgage is we just ask them. So ask every single seller that you talk to. Just because it's listed and it doesn't say seller financing in sub 2 does not mean that you cannot assume the loan. Another great way to find these deals is to search the pre-foreclosures. We've talked a lot about pre-foreclosures in previous videos. These are listed on the county's website. It means that the seller or homeowner has not paid their mortgage, they're in pre-foreclosure, and they're going to get foreclosed on. So these people, they need to bring their loan current, they need to sell the house, they need to do something in order to not get foreclosed on. They are a ripe candidate to come in and bring the loan current, save them from foreclosure, and see if you can assume their existing loan. We've done this a few times. A good way to play these sub 2 deals is not just for you to keep this house and move your family into, maybe keep it as a rental, but another great way to create some good cash flow without any responsibility and also create some good equity is to take these existing loans, mark up the interest rate, mark up the purchase price, and wrap it. Seller finance it to someone else. If you assume a loan that has a 3% interest rate and then you go ahead, you wrap that deal and seller finance it to someone else at an 8% interest rate, you are keeping the difference between 8 and 3 and collecting that 5% interest every single month. You're not going to own the house, you're not going to pay the property taxes, you're not going to pay the insurance, you're not going to pay the maintenance. You just get to collect that 5% difference. I know what you guys want. Y'all want action steps. How do I do this, Alex? How do I find these deals? Well, let me tell you, and don't overcomplicate it. Here's the one thing you need to do, the one action step in order to find some sub 2 deals. Hey, would you consider seller financing it to me? Oh, you would? Well, can I assume your existing mortgage that's in place? Seriously, guys, you don't need to overcomplicate this. Just ask questions. Hey, would you consider seller financing? Cool. In order for me to make this deal work, I need to assume your existing loan that's in place. How does that work? Well, at closing, I'm going to get the property, I'll pay you the down payment, I'll assume your existing loan, and I'll take over the mortgage payments from here on out. You don't have to worry about it. I'll pay the bank and I'll assume the responsibility of paying this mortgage. No, you won't consider seller financing? Well, I'm just not so sure that this deal is going to work out for me unless I can assume your existing loan that's in place. Ask every seller that you talk to, would they consider seller financing? You never know if you don't ask. Don't overcomplicate it. You don't need a 12-step process of how to find some sub 2 deals. All you need to do is ask, would they consider seller financing it and allowing you to assume their existing mortgage? When they say they're open to it, or when they say that, yeah, they would consider it, or hey, what does that mean? At that point, that's when you go into further negotiations. You explain to them what it is, how it works, and how you're going to be able to benefit them, and also at the same time buy a deal that's going to benefit you. It needs to be a win-win scenario. So what are you waiting for? You know the secret. So get out there and go take down some deals. Become the real entrepreneur that you're created to be. And hey, if you need any help, we're here for you. Anything as little as questions to something as big as us taking down deals together. You'll always have a partner here at TRE. But before you go, drop some comments below with what you want our next video to be. I promise to personally respond to every single comment that we get. Thanks again for watching today. Don't forget to subscribe, and I can't wait to see you in the next series.